Good day, this is Anita from Kirtana Nara College. Today let us discuss some of the topics from the security analysis and portfolio management. Now let us discuss the meaning of investment. Actually, investment refers to the allocation of money by the investor in different sources. Here the investor will allocate the money in different sources with the expectation of earning more profit or sometimes any return. Now let us discuss some of the avenues. Now the first one is stock. In stock market, the investor will invest his money in shares and debentures. The shareholder will receive dividend as well as the debenture holders will get interest for his investment. Bond. Bond is a debt instrument actually issued to raise the capital of the organization. Usually the municipality, corporation and governments will issue the bond. Mutual fund will give more income rather than other investment based on the risk taken by the investor. In real estate, the investor will invest his money in the properties. By return, he will get the rent and as well as some appreciation in the property's value. Commodities. In commodity market, the investor will invest his money in gold and silver. The appreciation value of the material will be the income of the investor. Currencies. In currency, the investor will invest in foreign currencies. The appreciation value of the currency will be the income of the investor. Now let us discuss some of the factors which are influencing the investment choice. The first one is risk tolerance. Here, before investment, the investor has to decide his tolerance about the risk. He has to manage the risk. Investment horizon refers to the period of investment. Based on his need, he has to determine the period of the investment. Financial goals also the main factor which determine the investor's investment. The economic condition of the country also determining the investment decision of the investor. Government will give some tax deductions and reduction for some other investments. So this is also one of the main factors which influence the investor's choice. The current market condition also determining the choice of the investor. Based on the liquidity need, the investor has to decide his investment. Now let us discuss the portfolio management. Before that, let us know the meaning of portfolio investment. It refers the various investment of money in different sources. So the investor is investing his money in different sources with the intention of earning more profit. He is taking more risk also. While portfolio management refers to the management of portfolio investment. Here the investor will manage the investment in shares, bonds and mutual funds, etc. Now let us discuss the uses of portfolio management. The first one is risk minimization. The portfolio management is very useful to the investor to minimize his risk. Then it is very useful for the optimal asset allocation also. The wealth maximization also be the good use of the investor. Then performance evaluation also one of the use of the portfolio management. Then the investor will get better planning options while he implement the portfolio management. The investor will get tax efficiency and he will know the knowledge of how to manage the tax payment. And it is very useful for the liquidity management also. Now let us discuss some of the factors which are affecting the investment decision in the portfolio management. Here the main factor is economic condition. The current economic condition of the country is determining the investment decision in the portfolio management. The interest rate given by the issuer also the main factor for the portfolio management. Then the market trends, then political stability also the one of the main thing which determine the factors of investment decision. Then risk management, it is also one of the main thing. Before that, the investor has to analyze the risk tolerance of himself. Then the investor's objective is also determining the portfolio management decisions. The global events like natural hazards, then war, also determining the portfolio management investment. Now let us discuss the meaning of bond. Bond is a debt security issued by the municipality, corporation and by the governments to raise the capital of the organization or company. Here the issuer will get interest for his investment. The reasons for issuing bonds. Here now let us discuss why they are issuing the bonds. The first one is to raise the capital. Here the bonds are issued by the corporations or by the governments to raise the capital of the particular company at the time of expansion of the particular organization. Interest rate advantages. Here in bond, the issuer will give more interest to the based on the risk taken by the investor. Here some of the bonds will get tax benefits like tax deductions from the government side also. Here the bond are diverting the investors from the bank loans and from the equity markets. Now let us discuss some of the types of bonds. The first one is government bonds. Usually it is issued by the national government. Then the second one is municipal bonds. So these type of bonds will be issued by the state and local governments. Here they will enjoy some tax exemptions also. Now corporate bonds. Usually it is issued by the corporations. Based on the risk, the investor will get the return. Convertible bonds. These type of bonds can be easily converted into equities. Zero coupon bonds. Here, this type of bonds will be issued in the discounted value. At the end of the maturity period, the bond holder will get the face value of the bond. So the difference between the discounted rate and the face value will be the return of the investor. Now let us discuss high yield bonds. It will be issued by the entities. Here the bond will give us higher rate of return when we are comparing with other bonds based on the risk. Now let us see the meaning of preference shares. The preference shareholders will be given more preference when we are comparing with equity shareholders. He will get preference at the time of getting dividend as well as at the time of winding up or liquidation. Now let us see the features of preference shares. The first one is dividend. The preference shareholder will get dividend as is based on his investment. Then priority in liquidation. At the time of liquidation, the preference shareholder will be given more preference when we are comparing with the equity shareholders. Non-voting rights. Actually, the preference shareholders will not have any voting right at the time of AGM or other meetings. Convertibility. We can easily convert the preference shares into common shares, that means equity shares. Cumulative versus non-cumulative shares. Here the cumulative preference shareholder can claim the unpaid dividend in the upcoming years also, whereas the non-cumulative preference shareholders will never get his dividend, unpaid dividend. Redeemable preference shares can be redeemed by the issuer at any time of the maturity period. Irredeemable preference shares cannot be redeemed by the issuer in its lifetime. Efficient market hypothesis. Here, efficient market hypothesis, according to EMH, it is impossible to get the higher return continuously. So, all the investors have to face risk. So, they have to manage the risk. Here, it has three forms. The first one is weak form, semi-strong form, at last strong form. Markowitz model. It was introduced by Markowitz in the year 1952. Here it focuses on trade-off between risk and return in portfolio selection. Here in this model we have to study how to minimize the risk by the investor. So this model prefers the portfolio investment to the investors. Here it has three components. The first one is expected return, portfolio variance, then efficient frontier. These are the main components. Now let us discuss the arbitrage pricing theory. So it is a financial model actually. It explains the asset prices. The asset price will be calculated based on more factor analysis in the market. So it will be a efficient market. It gives opportunities exist in an efficient market. Now let us discuss the uses of arbitrage pricing theory. It determines the asset pricing. So it will determine the asset pricing by analyzing the market. It helps in portfolio management also. Then it assists the investor to how to manage the risk. It supports the investment decision making also. So based on this model, the investor can decide the decision making also. It improves the asset allocation strategies also. It analyzes multiple risk factors also. Now let us discuss the portfolio performance evaluation. So the investor's portfolio investment should be evaluated. So because we have to analyze whether the investor has invested in the proper avenues. So to understand how effectively the portfolio manager has invested funds and to improve the decision making. In fundamental analysis, it is very useful to the investor to decide what to buy, when to buy and when to sell the securities. So the actual financial health and potential for future growth. The main objectives of fundamental analysis are, the first one is economic analysis. In this, the economic condition of the country should be analyzed properly. In industry analysis, all those related industries should be analyzed. Then in company analysis, the company should be analyzed and it should be compared with other companies also. Now let us discuss the meaning of technical analysis. It is a method used to evaluate and forecast the future price and movement of the securities by analyzing the past market result. So the historical data will be calculated and it should be very useful to forecast the upcoming changes in the securities market. Now let us discuss the objectives of technical analysis. The first one is to identify the market trends. It is very useful to analyze the market values. Then to predict the future price movements also it is very useful. So based on the result given by the technical analysis, the investor can predict the future movements. To determine the entry and exit points also will be calculated. Apart from that, it is very useful to minimize the risk and to maximize the profit or return. It is very useful to study the investor's psychology also. So this method is very useful to study the investor's psychology. To support the short-term trading decisions. So based on the result, the investor can take his short-term investment and the decisions also. Now let us discuss the Dow theory. It was developed by the Dow. Actually, it predicts the future market trends. So based on all those analysis, it is predicting the future market trends. It states that the stock market moves, how it is dominating the economic condition of the country. So all the movements of the security markets are creating some impacts on the economy of the country. Here it consists some of the trends. The first one is uptrend, downtrend and sideways. And by studying these trends, the investor can make informed decisions about buying or selling securities. So Dow theory is very useful to the investor, how to buy any security or how to sell them and when to sell them, and it will manage him the market trends also. Now let us discuss the uses of Dow theory. The first one is it identifies the market trends. So Dow theory is very useful to analyze the market trends. So based on that, the investor has to invest his fund. It is very helpful in timing buy and selling decisions. So it is very useful to take selling decisions also. It confirms trend reversals. It assists in long-term investment planning and it supports the technical analysis also. It improves the market sentiment analysis also. Apart from that, it provides the risk management insights. So based on the Dow theory, the investor will get or educated how to manage his risk in the upcoming years. It enhances the trading strategies also. It is very useful to the investor to frame some strategies to be a successful one. Thank you.